It is a great pleasure to be here at Basilea Lease2021, speaking about the impact of Basel IV for leasing. I will also explain Leaseurope proposals to recognize the low risk profile of leasing within European prudential regulatory framework. First, I would like to describe the Basel Agreement that was approved in 1st of January 2023. This relates to the slide number 1. The agreement, which was approved, has been delayed until 2023, 1 year, because of COVID-19 pandemic. The main elements of the revision includes a revision of the standardized approach for credit risk, a revised IRB framework, a revised CVA framework, a revised operational risk framework, a revised market risk framework, a revision of the leverage ratio and a new ratio for the G-SIBs, a capital buffer, and the introduction of a new output floor, which is going to limit the use of internal models. So, how this agreement affect leasing? First, regarding the standardized approach, for those leasing companies that use that models, under the standardized approach, there is not much change in the new agreement. This approach takes into account the PDs and LGDs, the risk parameters, and provides with a specific risk weights for each asset class. The ones that are relevant for leasing includes unrated corporates, which will take the risk of 100%. There is also new calibration for SME exposures, we will have 85%. For retail, you will have 75%. And for the rated companies, depending on the rating, you will have a different risk weights. This means that the standardized approach currently treats leasing in the same manner as a secured loan. The new agreement will not change this. Therefore, the collateral of leasing is not recognized within the prudential framework. Regarding the IRB approach, we have a number of changes as well. So for those leasing companies that use internal models for calculating of credit risk, they will also be impacted by the new regulation. This relates to the PPT number 2. First, I would like to explain the output floor. The revised output floor limits the amount of capital benefit that a credit institution can obtain from its use of internal models relative to using the standardized approaches. Banks' calculation of RWAs generated by internal models cannot in aggregate fall below 72.5% of the risk weights asset compute by the standardized approaches. This means that there is a limit on the benefit a credit institution can gain from using internal models to 27.5%. As you can see in the slide, how the output floor works. So basically, you will have a cap on the used. In the example that is shown, you will see that there is a limit, which is the red bar, and everything which is below, you will not be able to use it anymore. What is the impact of this for leasing? Well, as explained before, today, leasing under the standardized approach qualified as a very high risk. So when you are now using internal models, the low risk profile of leasing will be capped. And therefore, for companies using internal models, the increase of capital due to this floor will increase significantly. Also, Basel Agreement introduced what they call the input floors. This means that there is a minimum floor value for bank estimated IRB parameters that are used as inputs for the calculation of RWAs. This includes the PD floors for both the foundation and the advanced approaches, as well as for LGDs and exposural defaults for the advanced approaches. Therefore, on top of the output floor, we also have limitations on the use of the risk parameters. As you can see in the table 3, which is in the slide number 3, leasing will qualify in different manners. So as you can see, the LGDs, which is the most impacted part for leasing will qualify in 15% other physical, when it's secured and corporate, and 25% when it is unsecured and corporate. When you have a retail exposure, it will be 30% for unsecured and 15% for secured. Normally, this is much higher than the actual LGDs of leasing. On top of that, the Basel Agreement also includes new haircuts. They have increased the haircuts that you apply when you have an exposure consider other physical collateral from 28% to 40%, which means that a bigger part of leasing will be considered as unsecured, and therefore it will have higher input floors as well. In addition to that, also the new agreement will not allow the use of the IRB for certain asset classes. For instance, you cannot use it, the advanced approach, for large and mid-sized corporates, or for banks and other financial institutions. The combination of all these will have a considerable impact on the risk capital required to leasing companies. This brings me to the second part of my presentation. Why leasing is low risk? Well, in Europe, Deloitte did an extensive research during the years of the financial crisis, which demonstrate that leasing business models leads to significantly lower risk compared to traditional lending. The graph that you can see in the slide number 4 will show you the default rates and the LGDs given defaults for leasing compared to banks. As you can see, in all the cases, leasing figures are much lower than average banking lending. Also, in the table 1, which you can see also in the PPT, number 4, the Cologne of University did calculations for the current CRR. For all these regulatory credit risk approaches, capital requirements are much higher than the unexpected losses for leasing in a downtown simulation. As you can see, for IRB, it's between 5% to almost 6% higher than the actual unexpected losses. And when you use the standardized approach to calculate capital requirements, the actual capital required for leasing companies, it's 8 times higher than the unexpected losses we have in the crisis, which means that today we are putting aside much more capital than the history of our unexpected losses shows. Why is that? Why leasing is low risk and why we have these figures? There are many reasons. One is because leasing companies are asset specialists, so they are very good at managing the asset cycle life. Also, normally, when a company leases an asset, it's usually a critical part of their business. So basically, in order to run their business, they need this asset. So it's usually one of the latest things they stop paying. Also, the leasing company, it's the owner of that asset, which means that in cases of default, the leasing company can take back the asset which belongs to the leasing company and resell it. In fact, in some cases, the leasing company actually makes money when a default occurs. For all these reasons, and in order to try to recognize the low risk profile of leasing and to mitigate the impact of all this new regulation that it's coming soon to Europe, Leaseurope has developed a number of proposals together with the University of Cologne. The University of Cologne, they used a data set of 20 major European leasing companies that covered 15 European markets. The data set is based on more than 2.4 million leasing contracts with a total outstanding portfolio of 45.7 billion, which means that it's a very representative sample. Based on this sample, what the Cologne University did was to translate the PDs, the LGDs, and the unexpected losses of leasing into regulatory proposals. As you can see in the slide number 5, this is a summary of all the various proposals that Leaseurope is today currently engaging with the institutions to be delivered. The first proposal, it's the standardized approach. Leaseurope is proposing a 65% for corporate leasing and a 50% risk weights for retail leasing. This proposal, it's based on a very strict criteria that has to be met in order to qualify for these risk weights. What we want is to avoid arbitrage and only to make sure that only high quality assets can qualify for the discount. In addition, we also propose a haircut for leasing that instead of 20 should be 40%. Given how leasing is structured, this will better reflect the assets that the leasing company has, and it will allow that a bigger part of the leasing exposure could qualify as a secured lending. Third, we propose also a new LGD leasing of 20% for those companies using the foundation approach. The proposal from Basel, it's quite high compared to the risk, the real risk of leasing. And finally, we also propose new LGDs input floor for leasing portfolios, both for the retail and corporates. What we propose is that instead of 15% other secure, we propose 10% secure leasing, the same way as today is the risk of the real estate collateral. And for unsecured leasing, we propose 20% instead of 25 or 30, depending on whether you are retail or corporate. So to sum up, as you can see, leasing, it's a low risk asset, is a low risk form of financing, which is also very important for the financing of SMEs and for the financing of the green transition in Europe. And today, the low risk is not recognized in the regulation. And in fact, the new regulation will even make the prudential treatment of leasing worse. So what we are now calling, it's on the institutions and all the regulators to recognize this and to take into account our proposals. We are waiting now for the European Commission to release a proposal by the end of October or early November, where we hope that this proposal that we deliver to them are included. We also hope that the Council, which includes the member states of Europe and the European Parliament, will recognize the low risk profile of leasing and will accept our proposals. Thank you very much for your attention.